Welcome back to our Nedgroup Investments Quarter One Fund Manager outlook and overview and report back. And we've done an absolute whirlwind of the world up until now, covering every geography, every political realm we possibly could. And I'd really like to bring the final session back home to South Africa, and no one better than Mike Lawrenson, Portfolio Manager on the Nedgroup Investments SA Equity Fund. Mike, thank you for joining us today.
Yeah, thank you. Looking forward to it.
Yeah, the last session, not the graveyard one, everyone's feeling nicely energized, but I think potentially one of the more important ones, what's happening here in South Africa and what you guys are doing within the portfolio. But maybe just go a little bit backward looking before we look forward and speak to some of the numbers that you've seen from a contribution to the portfolio up until now.
So starting in the quarter to March, we saw the fund up 5.8%. We beat the SA general equity benchmark, and we were in line with the capped Swix. On a one-year basis, we're slightly behind the index, but ahead of the general SA only benchmark, and that is primarily the fourth calendar quarter of 24. We had some underperformance there. On a 3-year basis and a 5-year basis, we are sort of in line to slightly ahead of both the general SA only equity benchmark as well as the capped Swix, and you can see since inception we're ahead of both as well. So that's good to see. Looking at attribution, I'm not going to go through everything that contributed, but I guess some of the key highlights here are AngloGold contributed strongly to the portfolio. It's been our preferred gold play, primarily back on improving cost profile with the new CEO coming on board. It's something he promised us 3 to 4 years ago, and he's been good to his word there. Absa, which underperformed, I think, in the first quarter, first half of last year, we added to that, and that has come through nicely. And we also like the new CEO that's been appointed. Foschini we've owned for a while, and that also performed strongly, although SA equity as a whole actually came off quite strongly post the November-December highs. Impala was one that we've owned for a while, and that has also come through strongly on the back of revised expectations on EVs being revised lower and lower secondary supply from the smelters.
So did you hold Impala through the platinum lull for quite a while?
We did, and we did add to that slightly, and it was our preferred choice. And it was a combination of, I thought they had more flexibility in terms of cutting costs as well as capex, and also they had the strongest balance sheet amongst the 4 big platinum producers. Remgro we added during the period. It's not one we owned throughout the period, but we added it at its lows in the sort of middle calendar year last year, and that's come through quite strongly. And then BAT, one that was a perennial underperformer in the last sort of 18 months, has also performed strongly, and we've actually used that as a funding mechanism more recently. We've been selling some of that and buying some more.
I think it was up north of 40% in the last year or so.
Exactly. Okay. But listen, it's still, I think it sits on a just over an 8 PE and 8% dividend yield. So yeah, it's still pretty cheap, but yeah, it's performed strongly.
And before we move off this slide, I want to pick your brain, because I know you're the resources guy, and resources do excite me. I think they capture the global demand supply dynamics, maybe better than any other sector. On the gold side, you made some interesting comments to me before we went live on the size of gold within the Swix. Maybe if you can elaborate on that.
So gold is, at the end of this reporting period, was around 12% of the capped Swix benchmark. It's probably come from about 3-4% over the year, and it's amazing how when a commodity price rallies like gold has, how the equities in this case have outperformed strongly.
They're almost outside. So if the gold goes up 50%, some of these counters have gone up 100%.
Yeah. So year to date, for example, I think Harmony's up around about 107%. Impala, sorry, AngloGold's up about 98%, and a Goldfields is up 95%. That was year to date to Friday. So I mean, significant gearing to the gold price. The $1 million question, I guess, is at what point do you sell gold equities on the basis that gold, while the current environment is very supportive of gold, and particularly what's happening with potential inflation or rising inflation in the US and the need to potentially reduce interest rates there, it should be supportive of gold. But if you look at gold over a long period, there are periods where gold does nothing or even goes down for 5, 7, 10-year periods. So right now it's supportive of gold, but at some point, gold will underperform. Just going through some of the key underperformers, Harmony Gold Mining is one of them. Our preference was to own both Anglo Gold and Gold Fields over Harmony. Yes, Harmony's the more geared one, but we had issues around, at the time, they're mining at about 12 grams a ton. Their reserve grade is 9, so they can't do that indefinitely. At some point, that'll reverse, and then that'll have a negative impact on your cost base. And currently, on average, 25 to 30% of 12 months forward production is actually hedged. Okay. So, they're not getting the full benefit of that higher gold price, but, they are the most geared. And also, from a diversification point of view, 90% of that business is SA-based. Capitec is one that we have only recently started buying. It had quite a large pullback more recently, so in fact after this period where we added some, but it obviously been a strong performer last year, and it cost us in terms of return.
Yeah, I think the market appreciates the entrepreneurial spirit and the ability to generate business. And maybe before you shoot off the slide, maybe I'll make a sniping parting comment you made. The ABSA seat being filled, obviously they lost someone to a superior bank, now new Nedbank CEO. I was just taking them back there.
Yes.
But yeah, I mean, it seems very diversified. I mean, I'm looking there now from your staples to your consumer related to, to your energy players in the likes of, Sasol, Remgro out there as well. So quite a nice diversified portfolio, you would say, going into the second quarter?
Absolutely, and I'm not sure whether we'll get to that slide, but we can speak about that later on, but absolutely.
Yeah, we might have to rush through here.
Exactly.
Might be running a bit short time. But yeah, so your market outlook, we've had a fair amount of conversations already around Trump and the tariffs, so maybe just give us your sort of minute view on the state of things.
Yeah, look, it's difficult to give a view because you don't know what he's going to say tomorrow, but certainly what he initially proposed was going to have a negative effect on global GDP. And what I think is maybe underappreciated by Americans, the American Main Street and the average consumer, is when they think tariffs, they believe that the companies who import those businesses, or maybe even the suppliers of those products that are imported, bear the brunt of the tariffs. In reality, the prices get passed on to the consumer, and that's, and that is why, the view is that it's going to have a detrimental effect on US inflation rate going forward, and if enacted in that worst case scenario, and potentially in a on a short-term horizon, you could see the opposite in the rest of the world, because you're going to suddenly find that China's potentially going to have to find a new market for the goods that were destined for America, and guess what? They're going to have to sell into South Africa. So golf clubs, for example, might suddenly find their way into the SA market at a discount because they're going to have excess supply. So yeah, it's it has bigger ramifications, and hopefully it's not enacted in the original format.
Well, the golfers have dialed in, the ears have just perked up. They're eyeing out the new tightest irons.
Exactly. So yeah, the chart on the left-hand side reflects the global economic policy, and you can see we are at extreme highs again. And in fact, that chart quite closely correlates with the gold price, and why. Unfortunately, the gold price is not on this, but yeah. And then the right-hand chart just shows you where, if enacted in the worst-case scenario, you could see tariffs rising up to about 23% of imports. Quickly, on the left-hand side, you can see that that pink line there, and that's about 4 days old. You can see that the market is expecting further interest rate cuts in the US. So there's pressure on Powell there, But his problem that he faces, that on the right-hand side, you can see that in the last year, in the last 3 months, we've had a significant increase in inflation expectations. So yes, he has a dual mandate, but you know, it's difficult to justify interest rate decreases or cuts when you faced with an inflation outlook like that, and that's pre-tariff impact as well.
Yeah, we've been trying to sort of distill that complex that we're currently experiencing. On the South African side, this is interesting for me, this chart that you have here on these freight volumes, for example. I was chatting to the Nedbank economic unit, and they were in this luxurious position when Nedbank used to manage some of the transactions for the tolls on our highways, and therefore had a pre-indicator for economic growth based on that.
Some insight. Yes.
Yeah, I don't know if I was allowed to disclose that, but I have. I don't think that's still the case. But maybe, talk us through what you're seeing. I mean, signs of bottoming this.
So on the left-hand side is rail freight volumes, and clearly we've seen a bottoming, and we've actually seen a nice pickup. I mean, some of that is obviously involvement of private sector, and particularly the miners in that, whether it's funding improved security on rail lines, or in some cases actually funding capex and getting it back in a reduced monthly tariff. The middle chart is just an indication of port delays, and you can see a significant improvement there. And I guess the bottom line of this is that most of this is pre the formation of the GNU. So the structural reforms are there, and they're in place, and we'll get to the GNU later on. And obviously, you know, we've had a few hiccups on load shedding recently, but I think largely the load shedding is behind us now.
Okay, good to know. I've just invested solar panels, but for the right reasons. There you go. So this is, I guess, speaks to SA on a valuation proposition.
So from a valuation perspective, you can see we're close in terms of PE, and this is our in-house domestic PE. So we exclude the mining companies, we exclude the dual listers, and obviously Nasperet's process. And you can see on a PE basis, we actually back to the sort of April 24 pre-GNU levels. And you can see we had the run to the midpoint post the formation of the GNU, and into November, December, we saw SA domestics run quite hard. The retailers, the banks, the Bidvests, Remgros all ran pretty hard. And then post sort of early Jan, we started, you know, sensing that there were some issues around the budget, and obviously we all know what happened with the budget impasse, and there was a proper correction in valuations, and again it was mainly SA Inc. And then obviously just after that, then we had the tariff issues, and you can see how the sell-off happened there. So not only did we have an SA-induced GNU risk off episode, but then we had a global risk episode, which has put our domestic valuations back to where we were a year ago.
Yeah, I think that quite starkly clarifies that response. Again, so this is on the 9 times
So this
forward.
is just comparing them all to the rest of the world. So you can see we back at that sort of 8.5, 9 level, and the US, which is the green line at the top, and I won't go through all of them, the US, the green line at the top has come off from sort of 23 levels back to 18.5. But I guess what this disguises is the fact that implicit in that 8.5 multiple is an expectation of 12% earnings growth on the S&P. And now some economic commentators out there have said, you know, if the US GDP growth goes from 2 to 0%, we could see a 14% impact on earnings. So if that is the case, and US S&P earnings growth reduces to 0, then that PE goes above 20 again, then it doesn't look as attractive as it does on that screen there.
Okay, great.
But the bottom line is SA, in absolute terms, it's below its 1 standard deviation, and it compares favorably with all the other global indices.
Okay. And then which direction it's going to go, I guess we're waiting for that clarity because there are certain drivers, and this is exactly, I guess you've lent into my question here around the backdrop. Maybe talk us through some of the key bullets here. My Garmin's screaming at me, telling me we're short of time.
Okay, so I'll be as quick as possible. So, you know, the backdrop remains supportive. Valuations remain supportive. The structural reforms, I think, have strong foundations. Yes, there are concerns around the sustainability of the GNU, but I think as time progresses, I think the probability of a complete sort of DA withdrawal is probably reducing. And the final point I guess I would make, I haven't gone through all the points on the slide, is I don't think the market was actually pricing in 2% plus GDP growth. It was sort of 1 to 1.5%.
Yeah. Brilliant, thanks, Mike. So we're already a couple of weeks into April. So how's the fund looking from a position point of view now, going into the Q2?
So what we've pride ourselves in is that you need a diversified portfolio. So while we're positive on SA Inc. and we've been increasing exposure to SA Inc., you can see in that slide we have banks and insurance exposure, and on the SA Inc. side itself, on the industrial side, we've got Foschini, we've got Woolworths, we've got Motors, Bidvest, and Remgro. Combined, that's around about 42-43% of the portfolio, but at the same time, you can't just invest in SA Inc. And so on the left and right hand side, you can see on the global consumer side, we like Naspers Process, particularly Tencent. Combined, that's about 27% of the portfolio, looking across what we classify as global consumer. We like AB InBev, we like the story there, I won't go into the details. And then BAT, which is one we've been selling, but it's still about a 2.5-3% holding in our portfolio, and Bidcorp, which is a good diversified global company. On the right-hand side, we've got some resource exposure. AngloGold is our preferred bet. Anglo American is our preferred bet on the mining side with the copper exposure, and then we've got some Mondi exposure.
Okay, fantastic. Mark, I appreciate you've actually brought together the conversation quite nicely, or the predecessors, your predecessors here today at least. We spoke a lot around what's happening globally in fixed income, the markets, but I think you've really driven home quite nicely what it means for South African companies on the ground. So appreciate your insights today, and thank you for joining us. We'll see you in 3 months' time to see if we can distill what happened in April, May, and June.
Thank you very much. Appreciate your time. Thanks, David.
Thank you. And of course, thank you to everybody for dialing in for our Fund Manager Workshop for Q1. Maybe similar to me, you got the sense that we spoke a lot about what's happened in the last couple of weeks in April, and it's very difficult to avoid that. There's one thing the market does appreciate, which is clarity. One thing the market doesn't appreciate is uncertainty, and the latter certainly seems to be prevalent at the moment. But who knows, by the time we next chat to you yourselves, the landscape and the global landscape and the local landscape, for that matter, could be drastically different. So from myself, David Levinson, and my Nedgroup colleagues, thank you so much for joining us today, and take care.